about how you analyze a BRR deal if possible, which kind of leads me nicely on to the deal analysis side of the webinar, which I did want to run through. So I do think it's vitally important to have some sort of tool that you use to analyze your deals. And by having such a tool, it not only allows you to store your data, it allows you to analyze numbers very quickly and make decisions. Because as Tony's already said there, if you're not quick in this game, especially with the hot properties, and the hot properties tend to be the below market value ones, because there's plenty of me out there, there's plenty of other investors bigger than me out there, and there's plenty of new people wanting to get in, there's plenty of deal sources looking for these type of deals. So you do have to be quick. So the quicker you can analyze all the deals, the better. So I just want to run through, I'll just increase the screen here because it's not very clear. So this is my way of analyzing the deal. So I've kind of pre-populated, but you'll see here, I've got let's just get rid of that. I've got a 4 or 5 tabs down the bottom here, which I'll explain as we go along. And effectively, this top data here is my data collection, and the link here is obviously, what we do is when we go back over each time, you can just click on the link, and if the advert's still live, the property's still available. So if you see, if we're, say, in 2021, a year down the line, and I click on this link and the property's still there, then, that's a year that property's been advertised for. So coming back to what Tony and I were saying there about motivated sellers, it does pay dividends to kind of build your pipeline and stick with it. So this has all been built. I am a bit of a spreadsheet geek. I do know how to, you'll see in here, there's lots of formulas. I know how to write formulas, and therefore I kind of put this together over the years. So effectively all it does is, I'll give you a quick rundown. So if, say, for example, we were going to buy a property for 50 grand, it automatically works out the stamp duty for you. Put a refurbishment cost in, no source and fee, mortgage broker fee, there's no HMO license. So details your costings. You'll see there's nothing in the discount including fees yet, because we haven't actually valued the property. So when I'm looking at a buy, refurbish, refinance, I am looking for a discount here, and later on I'll show you down here, I'm looking for my money out the deal. So at this initial stage of the analysis, I'm just sort of, what I would then do is, that's my setup. I probably, to be honest, might not put my offer in right yet. So in this example, the advertised price is 60 grand. I put an offer in there, 45 grand. Put in, whether it's pending or whether it's been, accepted or whether it's been rejected. And then obviously, where you're at. Because if you're going to be seeing the number of properties you need to see to acquire a decent sized portfolio, it's quite easy to forget what properties are what and what offers you've made. So you've got to document it all. I know I've done possibly 15 viewings in a day, and I can't even remember the first property I saw that day, never mind the day after or 6 months down the line. So you need to get everything detailed. In your refurb costs, you'd write in here in the notes. So you'd always insert a note of all the refurb, exactly what it is and what the costs were. So again, what needs doing rather than just a figure. All the white stuff automatically populates, obviously, depending on how much deposit. If you're bridging, you might put a 30% deposit down. Mortgaging to 25%. Arrangement fees and interest rates differ depending on the product, so you change that. Monthly rent, again, you'd use something like Mouse Price Rent Calculator. I find that a really good tool for finding out what your rents are, as well as just jumping on Rightmove, putting the postcodes in, and having a look there. So let's just, for argument's sake, say 500 quid. I run my own portfolio, so I don't have any letting agents fees, and insurance, let's just say £11, something like that. So based on what we then have down here is the analysis side of things. So you'll see here there's 4 sort of bold sections. So I'll go and pull a valuation from Zoopla. I'll then do the same from net house prices. Mouse price, I'll pull a valuation from, and then instant compare, I'll pull a valuation from as well. And then that gives me an average here of 66,750. So I would then probably look at maybe, just to be on the cautious side, saying that the new market value of this property is 65 grand. You'll see a load of figures have jumped in place there. And then if we go back up here, this figure here, in an ideal world, you want north of 15%. So if I put my original offer of 45 grand in, based on all the fees and the refurb, I'd be getting a 15% discount on that property. And what would then look at the refinance information. So you'd put another mortgage, a broker fee in there. And then you'd have your exit penalties. So again, depending on how you bridge it, or if you're using a cash investor, or if you're doing the mortgage to mortgage, you might have some exit penalties in there. So you just put them in. I'm not flipping the property, but if you did want to flip it, you put in your home buyer's report and your legal fees, and it'll tell you exactly what your return on investment is and what you should expect back. And that also bases on an estate agent fee to sell the property and paying 6 months mortgage whilst that property is listed and obviously going through the sale process. I then, if I didn't refinance, that's what the deal would look like. It would take initial investments 22,325. It's going to take 57 months to get all my money back out of that deal if I didn't refinance it. Obviously, as you know, I'm a big fan of buy, refurbish, refinance. So I look for these figures here. So this column and this column should be green. This should be green. I'm not sure why it's not showing green, but anything less than 36 months in that column should be green. So total investment 25. I'd only pull 13 grand out of this deal. Stress test monthly payment. So this runs that your mortgage, that your rent that you're going to receive is going to stack up on the mortgage side on the stress test. I'd have 26 months left in the deal until I got all my money out, and that's based on the net cash flow. And I'd have a 16% return on my investment. So what I then do is I'll just tweak it. If I'm not happy with how much money's left in, I'll go to 40 grand and see, okay, well, now it's 10 months. So that would probably be my initial offer on that property. I like to get as much of my money back out. You can see there's just shy of 3.5 grand left in the deal. That's not going to take long to get that money out. With the research, you can, the idea is to do a lot more. So what is the current EPC rating? You can find that out. Obviously, if it's anything less than sort of an E or an F, you might want to look to make some sort of environmental changes in the property. Make sure, maybe put some double glazing in if it hasn't got double glazing, or maybe just improving the heating systems as such. Current average value on your postcode, you can get that from Zoopla. Last 10 years value change, I think that's an important tool on Zoopla. I also look at the last 5 years and the last 12 months. It gives you a bit of an insight as to where your property is going to be sort of trending in the next sort of either straight away in the next year or next 5 or 10 years. What you can expect. I personally, at the minute, invest for cash flow. I'm not too fussed about equity growth. I think as long as I'm cash flowing a property, I create equity from day one and my money's not getting stuck, I'm quite happy with that. If I get some extra money on top in 20 years time, then great. But if I don't, I'm sure I've had plenty of money out of it cash flow wise. But naturally, hand in hand, you keep property for long enough, it goes up in value. So, if you get a good deal, you are going to have, equity on top in years to come. Granted, a 50 grand house in Sunderland isn't going to go up as much as a 200 grand house down in Reading over a 20-year period. But, that's not the game I play. Open rent guide, mouse price rental guide. So, there's 2 good rental guides there. So, that might have come out at 525 and 475, which then gave me the confidence to which gave me the confidence to then come up with my rental figure of 500 for that property. And then I then put in land registry sold data. So if it was sold in 2007 or they bought it in 2007 for 140,000, for example, I might put that in there. If it was sold in 2005 for whatever, 120,000, whatever it might be. Obviously these figures are just pie in the sky, and then just some notes about the property. So if you want to add any notes, the more information you put in here first time around, the better it is when you go scrolling back through. I think this is version 4 of this spreadsheet. So I've actually got like 4 versions of this spreadsheet now. Each one of them's probably got 200 or 300 deals on them. And, you know, the very first version, you know, you're talking years since I've seen those properties, but, you know, we still go back to them and we still ask if they're still available. If you wanted to do bridging first, rather than doing, obviously up here, this kind of looks at doing it the mortgage way. So this is kind of funding through a buy-to-let mortgage. Then we would look at the bridging loan calculator here. So the figures have all dropped out there. I'm not sure why. Let's just put them back in. Technology. I'm not having a good night with technology, are we? So yeah, so I just put the figures in, and then 1, 2. So if you want to look at bridging, then you'd put the bridging calculator stuff in here, and it would give you analysis exactly the same, and it would show you how much money gets stuck and how much cash flow you can get back. Now, I did a video today in the Next Level Property Investing Facebook group showing you that. Actually, I've got the figures here. So I had 2 remortgages come back today, and they did desktop valuations for me because they couldn't get the valuers out. So they came bang on the money of what I was expecting. And one, I did the mortgage to mortgage route, purchased it about last July it was, and I'm talking about now when I'm starting to get the money back out of that deal. I can't remember why I did it that way, but I did. Whereas the other one, I took the keys on that less than 2.5 months ago, and I've already looking at probably in the next couple of weeks having that refinanced onto a longer term product. So for me, bridging is a much quicker way to acquire property when you get yourself in that position. So that's kind of how I analyze a deal. And I just want to quickly, I'll just put in the rent here just so we can see the profits. I just need to quickly fill these in. So I'm going to then show you how I then analyze how I'm going to use the property, and how it can make your decision one way or another on how you should rent that property out. So obviously for me, there's a few strategies, and mainly being obviously single buy to let. So net profit's 389 at the start, but then it comes down to, once you've obviously refinanced it, you're going to pay a bit more mortgage payment, so it comes down to 330 a month. We then go into the SA analysis tab. So actually that's where it's gone. There she is. Right, there we go. Scrolled along the wrong. So there it is there in column D, you'll see. And then that same property automatically populates into the service accommodation analysis tab. So 3-bed terrace house, there's no reason why I wouldn't service accommodation this. 2 grand in furniture, I might spend 1,500 quid. That would be a rent to SA deal. Obviously we're spending 7.5 grand on the buy refurbish deal, but it doesn't really matter. If you're doing if you're just doing rent to rent straight off the bat, all you would do is fill in this top bit here. And then that would and then you jump straight into the SA calculator. You wouldn't necessarily fill in all this information because you're not going to buy it. So if you were just doing rent to rent, you'd just jump in here. You know, you might put that, you got a £600 deposit to put in there. You're going to do a £1,500 decoration, and you got your 2 grand furniture. So it's 4,100 quid in total. For my situation here, obviously it's just I'm going to use one of my properties. So then these grey areas are basically what you fill in. So you can see there the mortgage payments pulled through automatically. Whereas if you weren't doing a BRR on it and it was just straightforward rental, you would just drop in whatever your rent payment might be in there. And then you work through your council tax, your rates, your cleaning and your linen automatically populates based on your night stay, which I'll show you down here. I'll just get rid of these for now, and then I'll show you. Insurance 19, telephone in there, whatever. Yeah. So, and then your VAT. So what we then do is, you know, from the analysis that you would do Again, there's videos on the YouTube channel. If you just search Ryan Luke Property, you'll find the channel. There's videos on there on how I search, use Airbnb and Google Maps to find rates for nightly bookings. Let's just assume 75 quid through the week. We have 8 weekend nights booked and we charge £99 a weekend. Automatically populates that you're going to have 8 bookings per month with an average minimum night stay of 2. So I've already pre-populated that, and I've pre-populated the £25 cleaning and the linen cost. Gives us an average nightly rate, and then it drops in our cleaning and linen hire. As you'll see here, if I change that to an average of 3-night minimum stay, the cleaning and linen hire cost drops down, and then tells you what your gross revenue is. OTA commissions is obviously, you pay Booking.com, Airbnb, etc. to advertise for you, and running cost 871, which comes from here. And then obviously we're VAT registered, so we have to pay the VAT, unfortunately, on our service accommodation operation. But that's just part of, I guess, pushing past that threshold. And, it just is what it is. It's a business cost, and you just have to live with it. So this then does a seasonal analysis. So based on occupancy rates in January and what your sort of rate might be. So this is taking 95% of the sort of standard rate that we're putting in. And as you'll see in the summer months, it kind of boosts it up because, you do tend to get a bit more occupied in the summer and you can put your rates up. And, I do think this summer is going to be a good summer for serviced accommodation and a good chance to catch up what's happened sort of around this period here due to COVID. This then looks at the initial payback. So you've got in red here, it shows anything past month 7 in red, I would not buy into the deal if it was a rental deal or a creative strategy deal. I want all my money back out within 6 months. So this is based on, so this money here. So if I was having to pay, a deposit of £1,000 and I had to refurbish for £2,500, then you'll see there that's all gone red because I'm not going to get my money out within the 6-month period based on the net profit. But, you see there we're down to month 6. So each month, so I would buy into that deal, but I wouldn't if it was any more and it dropped into month 7, I'd have to renegotiate the rent and get it down. So it kind of shows you when your initial money will come back out that deal and when you'll start making some genuine net profit once your costs have been paid back. And it gives you kind of first, second, third year profit. Now these increase based on, when you're on the booking channels for long periods of time, you do start to, get listed more. You're seen as a preferred partner. You've got lots of reviews. So naturally you're going to pick up and you're going to be able to charge slightly more. So that's kind of, it runs at the SA analysis. We then jump over, maybe this 3-bed terrace had 2 reception rooms and you decided you might want to knock it into a 4-bed HMO. Jump on the HMO analysis. So we might actually have a sort of 1,500 quid refurb to knock a wall through and turn it into a bedroom and do a few other bits and bobs. Again, we've got all the costs in here. We've got obviously the cleaning fee is more of a fixed fee for bi-weekly cleans, and then depending on what you want to run with TV lights, etc. Assuming rather than nightly rates, we rent each room out for £400, and obviously our gross revenue 1,600 quid. You don't pay VAT on rental income, so there's no VAT to consider. 729.99 profit. So my money's back out within 4 months within that deal. So annualized profit, year 1, year 2, year 3. So that's increasing. And then comparables, it basically tells you which is the best strategy to use. So that's your single let profit over a 5-year period. That's your SA profit over a 5-year period. And that's your HMO profit over a 5-year period. So, it gives you an insight as to how you then want to run that property. Now, not all properties are going to fit into, if you can only get, if you've got a 2-bed flat, you could SA a 2-bed flat. You might not be able to, run that as a mini-mo. So it might not be relevant. You'd probably only be comparing a single let versus SA on that front. So similarly, if you've got a 5 or 6 bed HMO, it's always going to top trump a single let, but it just depends on kind of what you want from it. So that's how I analyze deals. And I mean, talking through it there has probably taken 10 minutes. When I just do it myself, pinging the research in, it probably 10, 15 minutes to put it all together. And then I just quickly look at this and make some decisions and start making some offers. So that's kind of, that's kind of how I use it. Now, one thing I've actually improved this. So the investigators, I then want to run through how I kind of focus, my time, the sort of things I track with our business to make sure that we're constantly pushing forward. So this is kind of my, this is what I look for our company outlook. So every day I'll put in how many leads we've received, whether it be from the Facebook marketing spend, whether it be direct through our website. So these are acquisition leads, whether it's people ringing us up, you know, whatever it might be. So, you know, let's say I got 5 leads today. I would normally as well make a note of where those leads came from. So I might put Facebook lead times 2 in a bit more detail, a Gumtree lead, you know, whatever it might be, a phone call from a letter drop, you know. And then in the letter, I've actually got a separate spreadsheet which tracks all the marketing activity, so we know which letters are not. How many viewings are completed? Obviously at the minute, not very many, but the more viewings you complete, the more offers you're gonna make, and the more offers you make, the more deals you're gonna get. So for me, if these figures are low, then I know we've got a problem. I know I need to push the leads more and the marketing activity more. If we're not getting on enough viewings, I need to figure out why. Is it because I'm not spending enough time doing it, or as a company we're not spending enough time doing it? You know, I think I've mentioned before, about a year ago, I found myself getting really dragged into the operations, and it wasn't until I analysed this data I realised the viewings had dropped off a cliff, and no doubt the properties acquired dropped off a cliff as well, because it is a numbers game, and I keep saying this. So so to this day, I still track this every single day. You know, everyone that works for me reports in various figures. So anyone on the front line acquiring properties, they report in this exact same figures. They'll report this column in and this column in, and then I obviously add them all together and put them in. On the SA side of things, I look at what our daily booking total is. So, you know, prior to COVID, we were doing anywhere from sort of 2 to 3.5 grand a day. Obviously we've dropped right down on that, but it has started to pick back up again over the last week, which I've noticed, which is a sign for me that the market's coming back, and it gives me a bit of confidence that now is the time to really start hammering these deals down, starting to get them acquired, get them set up and get them ready to go. Booking projection. So every day I look at what our monthly booking projection is. So on the 1st of May, I'll go from the 1st of May to the 30th of May, and I'll see what the gross revenue projection is. And every day I look at it. So obviously I'm looking for it to increase towards a certain level each month. How many properties we've acquired that day, how many contracts we've got pending. So this is more on probably the managed side of things than anything, but you know, how many contracts have we got out there waiting to come back? How many properties have we got in refurbishment? You know, because again, I want to see this, I want to see a number in here all the time, but I also want to see the number decreasing, because I want to make sure that we're rattling through the projects as quick as we can. Over the time, I haven't started, I've kind of not been going to the projects as much now, because I've got the sort of trust in the teams that we work with, and the trade guys that we work with, that I don't need to, but I do like to see this number coming down, because then I know that we're getting through them quick. And how many properties I've got in the pipeline. So, you know, these 5 leads we've received today, you know, they would go into the pipeline, and then we'd kind of work through them bit by bit. And again, I like to see a nice healthy pipeline. And from that, and by just analysing these numbers, you know whether you're heading in the right direction or not. And I've said it for a while, but I do think you can run your business just off numbers. The whole thing is a numbers game, and if you keep on top of it, then you know whether you're doing enough or not doing enough. If you're not getting enough leads, you're simply not marketing enough. If you're not doing enough viewings, you're simply not getting out and networking enough. You know, Tony's already said before how important it is to just go on viewings and meet people, build relationships. If you're not making enough offers, well, you're never going to acquire anything, because you've got to make an offer to pick stuff up. If I'm not getting enough daily bookings, I know I've got something wrong with the SA portfolio and we need to make some changes. If we've got too many projects in refurbishment, I know we're not doing them properly or quick enough. My account, so I log how much I'm owed each morning. So I obviously want to see this coming down, but obviously it does spike, and when it spikes, I get on the accountant and get them to chase the debt through. So again, that's just giving me the financial side of the business. Operations for service accommodation side. So how many cleans have we got tomorrow? How many cleans are scheduled? Did we miss any cleans today? If so, if that number's going up, I know we've got a bit of a problem. A value of refunds. Have we given any refunds away? Refunds typically problems for me, because it means we've done something wrong. They've checked in and something's not been right. Value of damages claimed. So again, if that's on the rise, do we need to, I actually don't run with a damage deposit, because I think you lose bookings. So would we maybe want to put one in place and then manage the numbers? Value of damages received. So obviously, even though we don't take a damage deposit, if someone does damage a property, we go after them for the money, or we might go through, Airbnb's host guarantee program or whatever it might be. Number of guests that have reported issues. Again, if that's on the rise, we know we've got a problem. So you can see that each one of these is just a very simple figure, but it kind of tells you a lot about your business. Then come on to the tenancy side of things. So how many rooms or houses have we got in total? So, whatever that number might be. How many rooms or houses have we got available out of that number? And then how many tenants have we got in arrears? So that's the total portfolio number. That shows us pretty much how occupied we are, and that shows us whether we're managing our, whether we're picking up the right tenants, or whether we've got issues that we need to work with, maybe on the accountancy side, or just with the tenants in general. So that kind of gives us a full glimpse of how I run my business, really, just by putting in a line of numbers, which takes me all of about 2 minutes every single day. And it just gives you a good outlook. So